Good morning. It's December 3rd and a cold one at that, 2022. It's the Wall Street Weekly Wrap Up, and I'm your host, John Newquist. We're going to go through what happened in the wonderful world of Wall Street. The jobs report came out Friday. Payroll went up. Unemployment held steadily. So part of the thing is they want to get the unemployment down, up a little higher so that this takes off the wage pressure, which takes off a lot of other issues with employers' costs. So they're not going to let anything come in for as far as immigrants. So we're kind of going to be in a status quo unless they open that up, because the minute somebody leaves a job in technology, they get a job somewhere in retail, and it's not maybe the same amount of money, but it's going to be there. It's going to be a job. The earnings, I thought 5.1, and if the inflation's at say around 7.5, you're getting an increase, you're still losing it. So the unemployment rate's been stagnant. We had the COVID spike way over here, but it's been under 4 for a while. So we're going to have to, probably endure more rate heights, and then there'll be a tipping point, and we'll see what that is. Originally the stocks rallied on Wednesday because Chairman Powell said rate hikes could ease in December. But if you kind of look at it, again, it's been a fairly steep rise. I mean, if you go over here, we're up 1.75 or 1.75 points, and the previous rise, I remember when the president said, "This is enough. You're killing the economy." This ain't the case in this case. It might get up to this level up here. Somebody says the rates might get up 5-6%. I've been there when it was double digits, so anything could happen. Stats for the week. I like crude oil because the Russian cap apparently is going to be $60. Not everybody's agreeing with it in Europe. That means they're not going to pay more than the $55 they're paying more right now for Russian oil in Italy and other facilities in Europe. So they're going to put a cap, and it's going to keep the price of oil a lot lower on it. Now the expecting is that OPEC would raise prices by cutting production. Sunday is the meeting. We'll see what happens. But I looked at the rates, the 2-year. I watched the 2-year already because you can just sit there and put money in there and get 4.5. Remember, inflation is taking it away though. So, but look at the oil. Boy, we broke below a level of support that had been there for a while, and there's one more level of support. So, it's in the 80s. It was down in the 70s earlier this week. They're going to make money at 60. So, we'll see where it's going to go. But it's in a fairly steady downcline. It's coming close to the end of the triangle. It broke down. Now the triangle just expands further out, and we'll see what happens. And I like the heat map for the week per se. Not a good week overall for stocks. You can see that the oil sector has been hit a little bit harder. We're overweight oil, and we're going to still stay that way because they're going to make a lot of money, and you're going to get the money back in either dividends or shareholder returns or buybacks of stock. So, I would worry if the oil starts to have a real chance going below 60. Then I would say, okay, maybe we'll underweight oil or, go in there. But a lot of the tech stocks and stuff, earnings, of course, Apple, has got problems with China and everything else. So, but if you look at it, if you would have just put the money in the S&P, minus 14%, but if you were tech heavy, which is a lot of people, 26%. We bought a lot in the October low, and but otherwise, I'm not a fan of buying a lot of tech right now because, was over high multiples, and it's a problem. Equity inflows. This is two different numbers. One is like a short-term 6-day chart, and we could see that people are pulling their money out, $23 billion in 6 days from the equities. Of course, they're nervous. I think I saw the number 50% of the money in the United States is sitting in cash right now. They're scared to do it, even though they missed almost a 20% rise on NASDAQ and tech stocks. They rather sit in cash because they're doing it. But cash, unless you're in there with bonds, you're not making a lot of money. But overall, if you did a 24-month rolling average, the equity inflow is good. So this is kind of like it still shows there's a lot of money going in if you look at it over a 2-year period. I like looking at the short-term period because you start to get the pattern. If it's pulling out every week for the last um, year, then eventually it's going to, come back in, and that's when the market's going to run. But by then, people missed 50% of the run up. The tech stocks that were almost impervious, and I want to say CrowdStrike, because if you look at the June levels, they went up all the way up into September, and even in October lows, they kind of bounced back up in the beginning of November. But the announcement this week with their earnings, it went down 17% pre-market. It jumped down. It gapped down below the horizontal support, so that's never a good sign. That means we are in trouble. It's going to be constant selling. It's not cheap stock, but the big issue is the numbers were low. People are holding and delaying spending, and I'm seeing that too. They are delaying things they don't need to spend money on because everybody's been hearing the recession's coming in 2023. It could be pretty ugly. So people are starting to conserve cash. And do we need the greatest software? Maybe not. Salesforce.com, same way. Less revenues expected for the current quarter. The metrics for the next quarter out, which has been the third quarter, does not look good. Coming down 10% short. And again, people are starting to put away these tech expenditures, which the one I'm watching is the data centers. I think there's going to be a slowing down of data revenue spending. If we're spending it less on these areas, you're going to see companies say, yeah, maybe we don't need to get such a big chunk of our money into the data centers. We don't have that much stuff, or they're going to negotiate lower prices. So we'll see. FTX fallout, holy smokes, it's everywhere. If I just take this chart, oops, excuse me. It's anywhere from tokens like Solana to hedge funds like Sequoia right over here. It's a lot of people affected by this fallout, and potentially over 1 million people are going to be affected by this. I think it's just a mess, and that's causing people to pull out of crypto and not put any more into crypto. Again, I have altcoins. I only got like maybe 7 or 8 of them, and not very much. Bitcoin is a big portion of the portfolio. I've been buying, every week that it's down below 20,000, I'm putting money in Bitcoin because I think it will be the future. I do think there's a demand for a digital currency, irrespective of any country's attempt to control prices. And that's what's going to happen. If this FTX wasn't here, it would probably be over 20,000. But just put some in. Don't put a lot. Don't put I know some people say put 5% in crypto. Well, why don't you just do to 1 or 2%? If it goes up, then you can add to it. Add to the winnings. Don't be out there, pounding on your losses. Cyber Monday, how did it go? Well, it went really good. A record. Remember Black Friday? A record. Cyber Monday, a record. People love the internet shopping. Point, click, buy. And what we're finding out is people have an idea what they want, and they go to the sites that have it and they compare. So, in the days of the old, where you were saying, well, I spent a lot of money on Amazon, that isn't happening anymore. Everybody's got websites. Everybody can compare the products. And, if free shipping is a deal, it might make a difference and stuff. I think, like I said, I looked at what I spent on the last 5-6 days. It was between 12 15 sites. Amazon was like maybe 2 purchases. So, and that's for all the holiday shopping and everything else. So again, I don't look at it as there. I think Jaffe's chasing the data center, and I think that's going to be a mistake because when that drops, when that revenue flattens out or goes lower, then you're going to see some big destruction of wealth too, as if we haven't had enough already. I want to talk about, excuse me, let's get over here and straighten this out. I'm using my mouse and it just wants to some days. I'm going to go over the last slide of every day. It's just to cover one of the stocks that we have in our portfolio. We've got about over 20 stocks. We try to be diversified in each of the 11 sectors. So Nextera, it's been a holding for well over probably 15 years. It's an energy company, wind power, everything else. Well managed, good dividends. I think we bought it. It was like 5%, 4% dividend. and it's split a couple times, and it's good. It's in the midway in the range. It's just one of those ones that, unless there's a fundamental problem with Nextera, this is going to be something we'll have in 10 more years. It's the market cap's high. It's some people, as they would call it, a utility company or energy company. It's pricey, but the performance has been there for over years. They make money. They buying back stock, and I think we're going to be okay with something like this, and I like it. So, I have no interest in trying to time the market, paying, capital gains and all that other stuff. I just rather hold on it, collect the dividends, and then reinvest it. All right, we'll see you next week, and have a good week.